So we've got Rhino Company, and we need to calculate the inventory turnover ratio for Rhino. So I want to bring up the formula because I want to focus on calculating the inventory turnover ratio first. And once we have the right answer, I'll then dive into how to interpret this ratio. Because ultimately, when it comes to the CPA exam, it's great if you remember the formula, but I feel that if you actually understand why somebody would calculate the inventory turnover ratio, it all of a sudden becomes much easier to remember the formula for the exam because now this concept is more intuitive for you. So let's focus on calculating this ratio first. So as you can see in the visual, there's not much going on with this formula. On the numerator side, we have cost of goods sold, and on the denominator, we have average inventory. Now, why is that? Well, cost of goods sold is obviously an income statement item, right? And that is incurred throughout the year. Inventory is a point at time. So average inventory allows us to take beginning inventory and ending inventory, and we smash those together to get an average. And that's our way of saying, okay, for the income statement, it's throughout the year. Well, we had average inventory of X throughout the year. So that is why we need to have average inventory. Now, if we look through what the question gives us, it doesn't give us either one of those numbers, right? So we need to figure out first, what is cost of goods sold? Well, like any other balance sheet account, we can prepare a balance sheet roll forward for inventory. And why is that? Well, they give us beginning inventory. And what happens when we purchase materials, right? That increases inventory. So as we can see in our roll forward, we'll start with beginning inventory of 17,000, and then we'll add purchases of 56,000. Now, what brings down inventory? That is when we recognize cost of goods sold. And that is the plug that we need to figure out. So we'll leave that blank. And then we get to ending inventory of 13,000. And the question gives us that. Well, it's easy to solve for cost of goods sold now. Because this roll forward has to balance, that means cost of goods sold for the period was $60,000. And that's going to be negative, right? Because again, when we recognize cost of goods sold, that reduces our inventory balance, and that is how we get down to ending inventory. So cost of goods sold, 60,000. Now for inventory, we just need to calculate average inventory. So we'll take the beginning inventory balance and ending inventory balance, add those together. That's 30,000 divided by 2. That gives us average inventory of 15,000, right? So step 2 was really easy. Now step 3, super easy as long as we have the formula and we have the inputs, and we do have both of those now. So we'll take $60,000 of cost of goods sold, divide by average inventory of 15,000, and that equals 4. And I'm going to say this is 4 times of turnover throughout the year. And so what does this mean? That means we sold through our inventory completely 4 times. We completely flipped it 4 times. And from a company's perspective, they want to have as high of a ratio as possible, because the higher that ratio is, that means that they flipped their inventory more times throughout the year. So flipping your inventory fast is a sign that you can produce inventory fast and then sell it fast, right? The longer that money stays in inventory, the less you can do with that money because it's tied up in inventory just sitting in the warehouse. So if I were to ask you, do you want to have a higher or lower inventory turnover ratio? You're always going to say higher, because I want to flip my inventory as fast as possible, get the cash out, and then reinvest it in the business, right? That is what this inventory turnover ratio allows us to understand for our business or any business that we're analyzing.